Okay, welcome back. You got the market, which is down 100 plus points, and things are looking a little weak at this stage. Now, Star Health is the next corporate we are speaking with today. The company has seen gross written premiums rise 14.5%. Net premium earned is up over 13% this quarter. We've also picked up from sources that Star Health is likely to apply to the insurance regulator for a composite insurance license. Anand Roy is Managing Director of the company. He's joining us now, as always, on the back of earnings and more. Anand, good to have you here. Thanks very much. So I have to start with that composite license business. Have you applied?
Morning, Prashant, and thank you for having me. It's always good to be on your show. The regulations are still evolving, and once they come into play, we will definitely evaluate that. We are, as we speak, we are looking at the opportunities that new regulations will provide to our company and our business. We will definitely look at it positively when we get an opportunity.
Which means that you will apply, right? Will you be manufacturing or distributing life insurance products? I mean, what's the thought process? Which way are you leaning?
So the thought process is that we are in a business of providing protection, financial protection, and we believe that there is opportunity for providing term life protection bundled with our products, the health insurance products that we have. We have a very granular and heterogeneous distribution, as you know, present in all parts of the country. So I think, this gives us a unique opportunity. We will see whether we will manufacture, these are decisions that has to be taken based on capital requirements and other things. So we are still waiting for the final regulations to come out, and then we will take a call.
Okay, let's talk a little bit about growth then. Your retail growth has been faster than the industry, and how sustainable do you think that is? Earlier, I think when we spoke to you, you said that you want to maintain a 20% growth rate. Is that something that's doable, Anand, through the course of the year and in FY24 as well?
Sonia, our retail growth rate has been growing much faster than the industry. We have registered close to 20% growth on the YTD basis. Even in Q3, we had a higher than the industry's growth rate, and we were able to increase our market share in retail health insurance business even in Q3. Our plan is to keep growing faster than the industry, thereby keeping on improving our market share. And this year, we are very confident that we will do 20% plus growth. And next year onwards, though I don't want to, give future-looking direction statements, but the way the business is poised to grow, I think we should be able to do better than that.
Okay, all right. Hi, Anand. Good morning. Nigel on this side. I think you're looking at a price hike to the tune of close to around 25% or thereabouts. Your loss ratio currently is around 64%. Do you think it comes down to sub 60%?
Well, the price hike has been taken in one of our products, the Family Health Optima, which is one of our leading products. And definitely, this will give a positive impact to our bottom line. The loss ratio should improve going forward. Typically, the price hike takes about 18 months to play out because the renewal book comes out over the next 12 months. So we will see that, the loss ratios will keep on improving in the future.
Do you want to give us a level? Could it come down to a particular level? Anand, we appreciate the qualitative aspects, but some numbers will be more beneficial for our, our viewers as well as your shareholders. Go ahead.
Yeah, sure. So see, we have given a direction of 63 to 65% for this financial year in terms of our loss ratio. And for Q3, we were already at around 63.8% as far as our loss ratios are concerned. So we are very confident with this price hike and the other strategies that we have. We should be able to deliver better than those numbers, but I don't want to give a number, put a number to it because, as you can imagine, the entire thing is dependent on a lot of external factors like medical inflation and all that. But I think we are well poised with this price hike that we have taken.
Okay, and on the bancassurance channel front, I know you want to expand quite aggressively. So tell us a little bit about that. How many new partners are you aiming to get on board? The contribution of the new business from the bancassurance side has increased to more than 10% now. What's the target there? And how many partners do you plan to get on board?
Absolutely. So the contribution has increased to more than 10%, and we are looking forward to this becoming 20 to 25% in the next year or two. I think the bancassurance and partnership will be a major play for us going forward. The regulations have also changed to allow 9 partners each from all the banks, banks can onboard. So we have some great partnerships already. We have just renewed our partnership with Punjab National Bank for the next 6 years. We have signed a contract with them. So I think, the new partners, we are in talks with many of them. I think I should be able to give some names probably sometime soon, but I don't want to, sound out something before we actually sign up with them.
Okay, all right. Anand, final question then before we let you go. Historically, Q4 obviously is a much better quarter. It's one of the stronger ones out there. Your combined ratio, what should it look like going ahead, around 95%?
Yes, absolutely. So it has already come down to below 95% in the third quarter, and we hope to end the year with less than 95% combined ratio.
Okay, all right. And, you briefly mentioned upon, you have applied for the composite license. There'll be some capital deployment, right? Do you have any number in mind?
No, so see, this is really, at our company, we are still evaluating this. Whether we will manufacture or we will distribute is still a decision we have to take. But we will see how the regulations play out, and then we will take a call. Capital is not a concern for profit-making businesses like Star Health. And I'm sure that, there will be enough and more capital available in case we decide to manufacture also.
I don't know if you guys have recently, I remember a couple of months back, I paid my health insurance policy. And I noticed a very sharp, steep increase
in the premium.
I mean, I know that I've aged a little bit, but then I called the company and they said, well, there was a 20% increase, which had been approved by the IRDAI. So I don't know if it applies to everybody or...
maybe you went into the next bracket as well, right? As your age goes up.
Yeah, I mean, it happens.
It does.
It's normal.
I paid mine as well.
You pay higher premium, right?
I know. Anand, are there more hikes coming? Sorry, I think you addressed that, but just to,
Yeah, Prashant. So see, the hikes are, taken very scientifically, based on actuarial data. We have, in our particular product that we have taken a hike, it's divided into 4 zones. So not everybody gets the same kind of hike. So zones which are relatively more profitable have a very less hike, and zones which are having very high, medical cost take a higher price hike. So I think, depending on various scenarios, we do this. But see, on a headline basis, 25% looks high, but if you look at the average ticket size of our product, it's 15,000 rupees, and 25% is maybe 3,500, 4,000 bucks over a period of 12 months. I think that's customers are willing to pay that much because they also understand the cost of healthcare going up.
Okay, all right. Thanks a lot for joining in. Have a great day. That's Star Health. It's actually seen a big fall in the last 6 months. The stock is down almost about 30-odd%. But the premiums have gone up, and that's perhaps something that works. Let's do one thing. Let's get back to the market now. Vodafone Idea is a big mover, up almost 15%. Indus Towers also up about 12-odd%. But on Vodafone Idea, if you're wondering what the big move is all about, Reema's here to tell us more. Reema.
Thanks so much for that. So the government has asked that AGR dues owed by Vodafone Idea to the government of 16,133 crore rupees will be converted into equity, which basically means that the government will now own shares of Vodafone Idea in lieu of AGR dues worth 16,000 crore rupees. This conversion of debt into equity will take place at the face value or par value of 10 rupees per share, and it will make the government the largest shareholder in Vodafone Idea with a stake of more than 35%. Now, this news is a big sentiment positive for Vodafone Idea, because it's been pending for over 1 year. And the thinking is that if the government has taken so long, 1 year, to deliberate on whether they should convert or not, the fact is that after thinking so much, if they've decided to go ahead and convert, which means they're committed to Vodafone Idea's long-term future. They want 3 private players and healthy competition in the market. So now with the implicit backing of the government, because as I said, the government will be the largest shareholder in Vodafone Idea, it will help Vodafone Idea refinance its bank dues, perhaps pay its vendors. One of its big vendors, which has been asking for repayment, has been Indus Towers. So now the hope is that Vodafone Idea will get the money from the banks to repay Indus Towers, which is why Indus Towers too has moved up. Remember, this is not fresh infusion which comes into the money, which comes into the into Vodafone Idea. No money comes into Vodafone Idea, but now it's got the backing of the government of India, because it will be a sort of like a PSU with a 35% holding. That said, analysts said that this is just going to provide immediate relief. It's a big sentiment positive. The company will still need external funds coming in to help on its 5G plans, because peers like Bharti and Jio have been accelerating on their 5G rollout, and Vodafone Idea is yet to get started. Back to you.
Okay, all right. Thanks a lot for that, Reema. And, let's keep an eye out on Bharti Airtel as well, because, the entire focus was there's going to be a duopoly market. If that doesn't happen, then is it a bit of a risk to Bharti Airtel. As we speak, the stock has moved to the low point of the day. So just keep an eye out on that one as well. But let's focus on the stock of the morning, actually. Mahindra & Mahindra Financial's Q3 earnings came in better than what the street was working with. The assets under management rising close to around 16%. Gross NPAs as well did improve to 15-quarter lows. The business update for January, though, indicated some bit of a decline and dispersals coming in at 5-month lows. To understand what went on in the past quarter, what went on in the past month, we are joined by Mr. Ramesh Iyer, the VC and MD of the company. Hi, Mr. Iyer. Good morning. Well, congratulations first on a very good set of numbers. The street has given you a thumbs up and they like those numbers a lot. Give us a couple of details, though. What kind of an AUM growth are you looking at? Could you guide for going ahead? Point number one. And the second factor is the dispersals, as I just said. In the month of January, it's come at the lowest we've seen in the last 5 months or so. Year on year, it's still higher, but it's come down to around 4,000 crores. Is there any slowdown, or would you say it's par for the course? Ms. Iyer, I think you're on mute, so I request you to unmute yourself so we could hear what you have to say.
Can you hear me? Sorry.
Yes.
So as far as the AUM is concerned, I've been saying this for a few quarters now, that we are seeing quarter-on-quarter growth in AUM clearly. And that's at the back of very, very healthy disbursement that's happening. And I think it will continue to move this direction. And we are currently growing at about 20-odd%. And I think we would kind of keep this direction. So far as January disbursements are concerned, one should understand it's at the back of a very big quarter that just went by. And therefore, there would have been some advance buying happening from January into the previous quarter. But we're not concerned. This is the normal trend that we are seeing. And then this quarter, you would once again see that the disbursements do catch up because the sentiments are pretty positive. Footfall is high. Availability is slowly improving. Pre-owned vehicle is doing extremely well. I think there is absolutely nothing that tells us that the volumes would not be available.
AUM growth will be 20% for the rest of the year and for FY24, right? That's your guidance?
That's right. We think that going forward, maintaining this kind of a disbursement growth, as again, I'm repeating, the sentiments are very, very positive.
Okay. So when you say sentiments are very positive, can you tell us what are the pockets that are seeing maximum amount of traction now? Because, earlier it was largely government capex that was undergoing. Now there is a pickup in private capex as well. So from the segments that you cater to, where are you seeing maximum growth come through?
So far, what we were seeing is in the personal segment, people who are buying, exchanging vehicles, upgrading themselves and all of that. Then the farm cash flows came and we saw sentiments getting positive through the farm cash flow. I think the contracting segment benefits are yet to come in. While we've started seeing them, I think the commercial segment, whether it's the pickups, whether it's even the tractor haulage application, I think all of this would start begin to happen now. So I think it's all three segments. We just saw the personal segment, then we saw the agri segment, and now we would see the contracting segment.
Mr. Iyer, the other leg to all of this, right, and I think a determinant for growth as well is interest rates. Now, I was reading a research report which says that cost of funds for you has moved up by only some 60 basis points since the fourth quarter of FY22, whereas the repo hike from that point on, that's the fourth quarter of 22, has been 225 basis points. Will we see further pressure with regards to rate hikes, or all that has to be absorbed has been done?
No, so clearly we are a well-matched ALM company, and therefore there was no hurry to immediately change our liability. Only as and when the liability mature that we will need to kind of borrow fresh, and that comes with some new rate. We've already taken some price hike, and in the last quarter there was a price hike up to about 75-80 basis points. So I think we are well covered for whatever is the increase. Our belief, though, is that in next 2 or 3 quarters, maybe post-festival, you would start seeing the interest rates come down. So we don't see any pressure on the NIMs to the extent that we need to cover, we already done.
So your NIMs will hold around that 7.5% odd?
Maybe at 20-30 basis points here and there. Fortunately, we've been upgraded to AAA. So that should get us a bit of 20 basis point from the market borrowing. So I think fairly around this NIMs, maybe a 20 basis point here or there could happen. And that could happen maybe also because of the product mix change and not necessarily because of the borrowing cost pressure.
Okay. And the other encouraging aspect is your asset quality has been improving as well. What's the rough number you want to give us in terms of gross NPAs and the net NPAs as well?
So in the previous quarter, we had this discussion on repossessions not being there, and therefore how much will it impact? And I was very emphatic saying that repossessions
Oops. Okay, I think there's some issue
are
with that.
not.
Mr. Iyer, we can't hear
Can
you
you hear
very
me?
well. Can you repeat? Yeah, can you repeat what you were saying?
No, I was saying that repossessions in the previous quarter wasn't there because of the limitations imposed on us. That's been opened up, and we would definitely resort to repossessions from such defaulting customers who've not been paying for long, or who have no ability to pay and want to probably surrender the asset. That should further help improve the asset quality for sure. And the overall collections have been pretty good. Even in January, if you see, normally at the back of a big quarter gone by, one expects the first month of the next quarter to be lower collection, but we ended up with 95% collection and the NPA holding up at the same level as the previous quarter. So put these two together, clearly we would see declining trend. I may not want to put a number, but definitely one would see a declining trend.
Okay. And, on your housing subsidiary, I wanted to understand that there is quite a bit of pain that you're seeing over there. The loan book has shrunk, the asset quality has deteriorated. Why is that, and what's the outlook now?
So it's a business that we experimented. We went into deep rural. We did, room addition, room expansion. It is not a whole house construction loan. And we realized that when there is a pain in the market, it's very difficult probably for those segment of customer to come back. So to that extent, there has been a pressure. We are now changing the mix of the book. We have got into affordable high-end customer in rural as well as into affordable housing. These two will put together, the book will change to 50% from affordable housing and 50% from the rural. And then you would start seeing change in both the color of the book as well as the growth of the book beginning to happen. And that's our clear strategy for the next 3 years from here.
Okay, all right, Mr. Iyer, we'll leave it at that. Thanks a lot for joining in. That's M&M Financial. Big mover, actually, 8% higher now. They're looking at 20% disbursement growth in terms of AUM and a good pickup in personal financing, personal vehicle financing, as well as a pickup in the rural market is what they're seeing. And that has perhaps cumulatively aided to their growth this time. No pressure, no large pressure on net interest margins is what M&M Financial has spoken about. By the way, the market is in a mood to reward good numbers, not just M&M Financial. You have Paytm that's up almost about 5% odd. Something like an SBI has come off from the day's highs, but it's had a very smooth run in the last 20 days. And then on the flip side, Adani group stocks are still under pressure. But let's get you the big newsmaker this evening. Finance Minister, or this morning rather, the Finance Minister said that there is no systemic risk to the market because of the Adani group stocks. Let's listen in.
Both SBI and LIC have issued detailed statements. And I know the chairperson or the CMD has himself come out and explained how they are not overexposed or whatever they said. Yes. And also said, look, we are sitting over profits for the exposure that we have, which is well within the limit. That's what I understand they have said, and I've again read it through the media. They have very clearly said that their exposure is very well within the permitted limits, and that they are, even now with the valuation falling as well, they are still sitting over profit. India remains as before, an absolutely well governed, stable government, and also very well regulated financial market. And as a result, I think the investor confidence which existed before shall continue even now. Our regulators are normally very, very stringent about certain governance practices, and therefore they shouldn't, one instance, however much talked about globally it may be, I would think is not going to be indicative of how well Indian financial markets are governed. The way in which inflation has come down, both by RBI's action and by the government's action, and the government's action has been steady and at it for some time. So I expect, since the fall in the inflation doesn't seem to be just a momentary or a 1 month affair, it should sustain itself in the process of coming down.
Any concern that you feel is there because of the twin deficit problems?
It's not as severe as before.
Yes.
Yes, when exports come down, you're going to have the current account deficit. But it's also now suddenly going up as well as it was before, a couple of months ago. Monthly fluctuations I say.
Yes.
Fluctuations should not worry us.
Well, quick check on the markets then. The Nifty went all the way down to around 17,712, and from there we've recovered close to around 60 points odd. Now that's 17,650 to 17,700. That's the important zone because there was put writing being seen. So the hope is that that level does hold out. And the reason we have seen a good recovery is because the Nifty bank is now up close to around 160 points. That's playing a good knock and continuing its good form. So just keep an eye out on that one. For the time being, we'll slip into a short break. On the other side, Mitesh Thakkar will be joining in to give us his technical trades.
Okay, the market is swinging around a little bit. We were down 130, we are down 70 now. So at the lower levels, there is some buying which is coming back. Mitesh is with us of earningswave.com back to run us through what he's making of the price action. Mitesh, morning again. What do you make of the activity so far, and near term, what trades would you want to take?
So, morning, Prashant. I think, while we had slightly negative first 50 odd minutes, but I think the overall setup hasn't weakened. And the recovery from the lower level kind of confirms it. 17,750 was our buying point with a stop below 17,700. So just managed to survive that, but I think still holding on to long positions. And on the stock side, IT is something, which is very clearly as a sector is showing good strength, and a lot of stocks are giving breakouts over there, especially the mid-cap ones. So FSL is something which is on the buy list. It's just giving some kind of medium-term reversal, so it can be a positional trade as well. But from the short-term point of view, it's a buy with a stop at 115 or just below it, and a target of around 125 can be looked at. And the other one which I like is Persistent Systems. That's a buy with a stop below 48.50 for targets of 5,045.
Okay, by the way, all Adani Group stocks once again under a lot of pressure. So Adani Transmission is now down 10%, Adani Power is down 5%, Adani Wilmar is down about 5%, Green, Total Gas, Enterprises, all down anywhere between 4 to 6%. So, despite everything that's happened in the last 24 to 48 hours, the stock market is still giving a thumbs down to these stocks. Maybe Adani Ports is seeing a bit of a recovery, but pales in comparison to the fall we've seen. Mitesh, a quick word on any of these, group stocks. I mean, would you look at a pullback trade anywhere, or it's a complete avoid?
So I don't know if you'll count ACC as the trade over there and Adani Ports. I think disclaimer that we have positions in both these stocks. I think, what has happened is that with this big fall, the option premiums have expanded. So buying into stock and selling call options would have been a good choice. Though Adani Ports has gone into ban on Friday, but I think before that we have had positions and looks a pretty stable one. I think the low for Adani Port around 400 has been made. 425, 430 to about 400 is filled with multiple supports on the long-term chart. So I think decline for this stock is over, and maybe on a bounce back, you will see selling at higher levels, but it can still bounce back to about 540, 550 odd levels. Similarly, ACC, I think, the lows of around 1700 and 1770 on the monthly chart is a big support area. So I think the damage is done, and you might see a pullback to about 2050, 2100 odd levels. Though I'm not looking at a big reversal, but with the options premium around 10% at the for at the money calls, I think you can safely buy into stocks and sell into options over here.
All right, thanks a lot for that, Mitesh, and thanks for giving us a quick update on the Adani stocks. By the way, Zydus is another stock in focus. Ekta is here to give us the latest on that. Ekta, over to you.
Thanks for that. Well, yes, the numbers for Zydus did come out on Friday during market hours. It was a strong set of numbers. The management commentary also has really fueled the incremental gains that you're seeing in today's trading session. They did hold their conference call on Friday post-markets. So a couple of key important takeaways. US, India and the API business were the main drivers in terms of growth. The domestic branded business for the company was up around 14%. They do expect the momentum to continue. Revlimid generic, which is basically the blockbuster cancer drug, is likely to make bigger contributions ahead for the company when it comes to the US business. FY24, in fact, they should probably see the launch of 3 transdermal products, which is basically a patch which can be put on your skin and the drug gets absorbed from that. plus 2 partnered products. They have guided for a launch of a limited competition drug in Q2 and Q3 of FY24 as well, and a hypertension drug which they have launched in the US could generate up to $100 million in FY24 and 25. So all of the opportunities in the US seem to be lining up quite positively for them. Incred target price is 593. According to them, the outlook is strong. It is their top pick. Motilal is neutral with the target price of 460 rupees.
All right, Ekta, thank you very much for that. Zydus in focus. Now, Paytm is seeing some green. It's up 5% or so. Abhishek is here to tell us why. Abhishek.
Well, Paytm reported their Q3 numbers. A contribution profit margin of 50.8% has helped them in coming with EBITDA positiveness for the first time in any quarter. So EBITDA is a positive figure of 31 crore, which compares to a loss of 393 crore YOY and about 166 crore loss quarter on quarter. So the total income is up 39.5% YOY and about 6.3% quarter on quarter. They have narrowed down their losses, which has come in at 392 crore versus ICICI Securities estimate of 500 crore and versus 779 crore in the same quarter last year and about 572 crore in the previous quarter. Back to you.
All right, thanks a lot for that. Well, just wanted to mention that for now, the Bank Nifty is the one that's holding up a tad bit. SBI has lost a little bit of its early morning gains, but IndusInd Bank, Axis Bank, HDFC Bank are all holding up in the green, which is a good thing actually, given the way the Adani Group stocks have fallen. It's good to see that the banks, the larger banks, are holding up quite steady at the moment. Let's slip into a quick break. On the other side, let's talk more about the banks. So don't go anywhere. Lata will connect with Sanjeev Chadda, the MD and CEO of Bank of Baroda, for a discussion on their Q3 numbers as well as how the environment is shaping up. Stay tuned.
Well, the stock markets are under pressure, but they are not the only market that are under pressure. At the moment, the rupee is also at its 1 month low, 82.45, 82.5 thereabouts, and that's the level we last saw probably a month ago, Jan 5th or thereabouts. And that's because the dollar has strengthened a goodish bit, 103 plus, on expectations that the US Federal Reserve may not stop with just one more hike. It may be yet another because of the strong jobs data. Likewise, the Indian bonds are also showing higher yields, 7.32 on the 10-year bond, which is actually now 11-year, but we'll take that benchmark, 7.24 bond. And the reason why the yields are higher in the bond is, again, because global yields have gone up. So just to put that on the radar, the stock markets are under pressure, but the Bank Nifty is not under pressure. And that's very important. There have been some sterling numbers, and one of them is what we're going to discuss. Bank of Baroda posted a solid set of numbers with earnings growth of 75% year on year, and that's led by a 50% year on year growth in operating profit. Asset quality showed a further improvement. I think the gross NPL declined by almost a percentage point, 80 basis to be specific, over the year. And the net interest margin is also at a 30-year high at 3.37. Sanjeev Chadda, Managing Director and CEO of Bank of Baroda, with us. Mr. Chadda, good morning. It's very difficult to ask a difficult question. It's a good set of numbers. So let me start by asking you your guidance. I mean, do you expect to continue with this kind of loan growth? What's the forecast for next half year, next 1 year?
So thank you very much, Lata. So I think in terms of guidance, we have been guiding that from the next year, that is 23-24, we expect to post consistently a return on assets of 1% or better and a return on equity of 16% or better. Fortunately, we have been able to hit those targets now. So I believe now onwards, we should be consistently seeing numbers of that kind. To my mind, that is powered, of course, by the cyclical factors. Corporate credit costs are down. There is the advantage of lag effect when interest rates rise. But there's also a couple of factors which I think have worked particularly well for BOB. One is on the growth side. So I think even last year we were growing pretty much as per market. But this was when our corporate growth was tepid. And because we had to choose between growth and margins. And at the beginning of this year, we had said, look, now we expect it is possible to have both. So you'll find that a corporate growth now is at about 13%, contributing as much as everything else. So that's one. And retail growth continues to be very, very strong. So our overall growth of about 20% YOY in terms of loans is powered by 30% growth organic in terms of retail. So that's a trend now that has been there for quite a few quarters. We would expect that to continue. And that is because, again, the major segment in retail, home loans, was a bit slow for us. Now that's picked up steam. In fact, home loans is the slowest retail segment at 20%. Everything else is even faster. So I think the growth part, to my mind, is something of which we can be reasonably assured. The second part, again, which is important for us, is costs. So when everything is improving, growth will happen. But for us, costs, again, have been growing appreciably slower as compared to the top line. In fact, the average increase in cost for banks is about 16%. For us, it is half. And that's in large part due to, again, the efficiencies that came in after merger. We had a very aggressive branch rationalization program. We hope to realize synergies of 10,000 crores over 5 years. That's working almost to a T. So I think this is a time when we can be fairly positive that the trend that you see now are likely to continue.
Okay, well, if you can give a more precise number for loan growth, I think you did 19.5. So for the year ahead, next 12 months?
So our guidance has been that in terms of priority list. First priority is underwriting standards, second is margins, and third comes growth. Now, I think because of the benign credit environment, credit costs are coming down. So I think we can be a little more reassured in terms of underwriting standards and credit costs. And also in terms of margins, I think now the margin seems to have stabilized. So I think we would still guide that we would want to grow at market or better. My own sense is that there'll be a little bit of a moderation of the growth we have seen this year. If we are looking at a nominal growth rate of 10.5% as per budget, normally it is a bit understated, should be a bit better, and say multiply it by 1.25 or 1.3. I think 15% is the growth I would expect for loans for the industry, and we'd want to do there a little bit better than that.
Okay. Well, let me first ask you the Adani questions and then come back to your bank because there's plenty others to ask. You have said that your exposure is less than 1%. What is the exact exposure? 5,400 crore.
So actually, the way we have been looking at is exposure, again, is computed in various ways, right? The most reliable way to compute that is as per the LEF guidelines of Reserve Bank, which takes into account outstandings, non-fund-based limits, undisbursed loans. So we have again disclosed that our exposure is less than a fourth of what is allowable under the LEF norms, A. B, again, it is not among the top 15 group exposures for us. And it has actually, as a percentage, come down over the last 3 years. So I thought it is very important, while it may not be possible to look at specifics in greater detail, but I think we owed a reassurance to our shareholders in terms of what is the possible downside for the bank. To my mind, I think quite apart from the fact that these are income earning assets, our exposure is very limited, and we're very comfortable in terms of that position.
Which specific companies, sir? Is it ports? Is it power, transmission?
So I think that's, I think, the advantage that comes with a diversified group, that even that limited exposure is spread over 8-10 companies which work in different areas, the largest percentage being operating companies with very strong cash flows, which is again a reason why we are very sanguine in terms of prospects as far as that is concerned.
What is large percentage? Would 75% be to profit-generating projects?
Absolutely. I think that's how it would work out. And in fact, we had also further, again, disclosed that of the exposure that we have, nearly a third, 30%, is where, again, there's a joint venture with a public sector company or backed by a guarantee of a public sector company. So I think there are a lot of mitigations which are there in place.
No, you know, the group has a lot of, for instance, airports under construction. The Mumbai airport will eventually start. You know, have you underwritten or agreed to loan for any of the projects that are under construction at this point in time? 25% would be that, you think?
So let me again say that, let me not get into further specifics. But okay, if there were a transaction of that size, I'm sure it would have been in the public domain.
Okay. Now, normally, how is it? Suppose you had agreed to fund the, say, Mumbai airport. Can you change your mind? How do these covenants work?
So I think the fact is that there are always commitments in terms of project design, in terms of project debt equity ratio, the fact that equity must come at least to some part upfront, after that proportionately. So I think in terms of projects, you tried, what is project finance? It is ultimately a way of making sure that all possible risks that you can foresee are mitigated, including the equity and execution risk, right? So as long, again, those parameters are in place, I don't believe there ought to be a problem. But again, we are, as a bank, not overexposed to project finance, very rarely in a lead in large projects. So I think that would so much more depend upon how the lead bank handles the situation.
And you were not asked, called upon to give any performance guarantee when foreign banks, bought bonds or gave loans to the group?
So again, we are getting. So I think I have given enough color on the exposure to again possibly indicate that we may not be. It's unlikely we'll be exposed to these kind of situations.
All right, fine. No, I mean these are doubts that keep cropping up in the minds of stock investors. So I'm merely presenting their doubts to you. Anyway, thank you for clarifying. I wanted to come back to margins. No, there's no taking away that deposit costs are rising, and every other day, even in railway stations, you see advertisements of people ready to pay 7%, 7.5% and more for term deposits. So is 3.37 margin a kind of peak? How much do you expect in the fourth quarter and next quarter in terms of margins?
So ultimately, really, it's two sides, right? One is, of course, in terms of how your resource costs are. The other is whether the environment allows you to pass on those costs. Now, last year, the challenge, of course, was that the environment with surplus liquidity was not conducive to passing on costs, which is why I explained to you we had been very conservative in terms of corporate loan growth. Now, I believe we have come to a stage where it is eminently feasible to make sure that you, again, protect your margins. Also, I think it's equally important to bear in mind that a large proportion of loans are priced at 1 year MCLR, right? So the repricing of those loans is over an extended period of time. The third thing which is important in our case is that you would have seen that the proportion of retail loans, particularly again unsecured loans where we had a relatively small portfolio, that's growing very fast at more than 100%. I expect that to continue to grow, and that also gives a very significant upside in terms of margins. So if you were to ask me overall whether we expect margins to sustain despite the inevitable increase in terms of deposit rates, which I think is also a good thing because it'll allow us to attract more deposits, I believe, yes, I think we should be able to sustain these margins.
Oh, that's very good. We didn't hear too many banks telling us that. And finally, your loans, I mean, like you pointed out, you have done extremely well in retail. But, sir, 30% year-on-year growth in retail, 29.4 to be precise. It reaches an area where you probably could be giving riskier loans. Would you worry?
So actually, it is really to analyze the composition of the growth. So we have been outperforming the market by a significant margin in car loans, for instance, in education loans also, where we have built very good businesses. For us, the drag was really home loans, where we were growing again at market a little lower. I think with the digitalization and Bob World, the access that we have to the market has improved tremendously. And the home loan piece, which was really dragging overall growth, because that is 70% of retail loans, that has now moved up. So I think given the fact that it is not really a one-trick pony, right? You have education loans, you have unsecured retail loans, you have car loans, you have home loans, your mortgages. I think the fact that all of these are consistently growing at a good pace, to my mind, would indicate to me that we should be able to sustain a fairly good pace of growth. Having said that, I think I had also spoken last quarter that there was some demand which was, of course, exceptional, right, post-COVID. For instance, I think last quarter, the YY growth in the automobile industry was more than 40%. Now, nobody expects that to continue indefinitely. So there will be a little bit of moderation, but nevertheless, in terms of retail growing much faster than the overall growth for us and our ability to outperform the market in retail, I believe that should remain intact.
Okay. Well, the market is pretty elated. Thank you very much, Mr. Chadha. The bank Nifty is down 0.25%, but Bank of Baroda is up about 1% in terms of share performance. And, a promise that we will be on return on assets above 1% is a big one. Investors won't miss that. We wrap up on Bazaar. Chartbusters up next.